Hey, CFA Level 1 candidates, welcome back. Welcome to FinQuiz. Hope you're doing well. All right, so portfolio management, huh? Today we're getting into the basics of portfolio planning and construction. And this is one of those topics where things really start to come together. I mean, this is where portfolio management really starts to feel practical. Now, one important thing to clear up right away. Portfolio planning does not start with picking stocks or funds. It starts with understanding the client. What are they trying to do? What resources do they have? What kind of constraints are they living with in the real world? Until that's clear, everything else is just guesswork. Sure, we can broadly categorize investors, individuals, pensions, institutions, and that helps. But even two investors in the same category can look completely different once you dig a little deeper. Different goals, different time horizons, different tax situations, different comfort levels with risk. That's why this module keeps coming back to one idea. Portfolio planning has to be client first and individualized. So as we move through this reading, we'll start by formalizing those goals and constraints into an investment policy statement. Then we'll see how portfolios are actually built, beginning with strategic asset allocation. And at the end, we'll pull it all together so it makes sense, not just on paper, but in real portfolio decisions. All right. So before anyone starts thinking about stocks, bonds, or what should I buy, we need to slow down for a second. Because in the real world, and honestly on the exam too, portfolio management doesn't begin with picking investments. It begins with a plan. And that plan lives inside one document, the investment policy statement, or IPS. Think of the IPS like a Google Maps route before a long drive. Without it, every turn feels random. One bad market year feels like a disaster. One good year feels like genius, even if neither really tells the full story. The IPS fixes that. It defines what success actually means before money is invested, not emotionally, on paper. So, in simple terms, the IPS explains what the client is trying to achieve and what limits they're operating under. And here's something important. Success doesn't mean maximum return. Success means hitting goals in a way the client can live with, especially when markets get ugly. That idea shows up a lot in exam questions, even if it's phrased differently. Think of the investment policy statement like a smart coach, not a micromanager. It doesn't judge a stock or a bond standing alone like, oh, this looks risky or this looks safe. Instead, it asks a better question. What does this security do to the whole portfolio? A volatile stock might look scary by itself, but if it zigzags when everything else zags, it can actually lower overall risk. That's the magic here. The goal isn't to kill risk completely. CFA never promises that. The goal is to reduce risk without sacrificing expected return. So we're not picking players based on individual stats. We're building a team that wins together. And yes, this exact idea shows up again and again in level 1 questions. So when you see in isolation, that's your cue to say, nope, think portfolio. Now, how does an IPS actually come together? It usually starts with a pretty honest conversation. Questions like, how stable is income? What keeps the client awake at night? Losing money or missing opportunities? Are there big expenses coming up? For institutions, this gets more technical. Asset liability studies, liquidity needs, governance rules, but the idea is the same. Understand the situation first, invest later. A common trap students fall into is assuming that all individual investors or all pension funds are basically the same. They're not. Two people earning the same salary can end up with very different portfolios because one panics in down markets and the other doesn't. That's why portfolio planning is always personal. The IPS exists to lock those differences in writing. Now, when you look at a typical IPS, it usually follows a familiar flow. First, it introduces the client, who they are, what kind of investor they are. Then it explains why the document exists in the first place, basically saying, this is the rule book we're going to follow. After that, responsibilities get clarified. Who makes decisions? Who holds the assets? Who monitors performance? This matters more than it sounds, especially in institutional settings. And yes, it does show up on the exam. Now, the procedures section of the IPS is basically the how part of the plan. It explains how the portfolio will actually be managed day to day, how investments will be selected, how often the portfolio will be monitored, when and how it will be rebalanced, and what happens if markets move sharply or the client's situation changes. Think of it as the operating manual that keeps everything disciplined and consistent so the strategy doesn't drift away from the client's objectives over time. Then comes the heart of the IPS, investment objectives. This is where return goals and risk tolerance are laid out together. And here's a classic exam insight. These two have to match. A client can't say, I want high returns, but I hate volatility. If you see that mismatch in a question, you should immediately be thinking this IPS needs fixing. Right after objectives come constraints. These are the guardrails, liquidity needs, time horizon, taxes, legal or regulatory limits, unique preferences, maybe ethical restrictions, maybe spending commitments. Some constraints come from the client, some are imposed by law, but either way, they shape what the portfolio can and cannot do. Once those limits are clear, the IPS usually spells out investment guidelines. Things like whether leverage is allowed, whether derivatives are permitted, or which asset classes are off limits. This prevents a portfolio from slowly drifting into something it was never meant to be. Toward the end, the IPS explains how performance will be reviewed, how often, compared to what benchmark. And many IPS documents include a strategic asset allocation, sometimes called the policy portfolio, plus rebalancing rules. If you ever see policy portfolio in a question, mentally link it straight back to the IPS. One last thing, the IPS isn't a one-time document. Life changes, markets change, regulations change. A good IPS gets reviewed regularly and updated when something meaningful shifts. From an exam angle, if a client situation changes, the first step is usually revisiting the IPS. So if there's one idea to lock in from this section, it's this. Every investment decision should make sense when traced back to the IPS. If it doesn't fit there, it probably doesn't belong in the portfolio. And just quickly, the battle-ready summary you're seeing on screen is built exactly for sections like this. It strips out the noise and keeps the exam logic front and center. If time is tight, it's a huge help. We've also got Stanley notes, formula sheets, and mock exams that reinforce how these concepts actually show up in questions. Links are right below if you want them. All right, let's move on. Next up is risk and return objectives, where this framework starts turning into real trade-offs and real decisions. All right, now this is where things get interesting, and this is one of the most testable parts of portfolio management. Risk and return objectives sit right at the center of the IPS. If you mess this up, everything else in the portfolio starts wobbling. So let's start with risk. When the IPS talks about risk objectives, it's really answering one simple question. How much pain can this portfolio realistically handle? Not just emotionally, but financially. The IPS needs to say that clearly in writing before a single dollar gets invested. Some clients express risk in absolute terms. That's when someone says something like, I don't want to lose more than 4% in any year, period. No benchmark, no comparison, just a hard limit. Think of a retiree living off savings. Markets can be up or down, they don't care. The loss limit stays the same. On the exam, absolute risk almost always sounds like a fixed loss number or a maximum percentage loss. Now here's the catch. If someone truly wants zero loss, the only way to guarantee that is, well, not taking risk at all. Bank deposits, guaranteed instruments. The moment risky assets enter the picture, absolute risk usually gets rewritten in probability terms. So instead of no more than 4% loss, it becomes something like with 95% probability, losses won't exceed 4%. That's where things like variance and value at risk quietly enter the picture. And yes, that language is exam gold. Other clients think about risk relatively. They don't ask, how much could I lose? They ask, how far can I drift from my benchmark? A portfolio manager running a large cap equity mandate isn't judged on whether markets fall. They're judged on whether they underperform the index by too much. That's where tracking error shows up. Anytime you see benchmark relative risk, think tracking risk immediately. Then there's a third way of thinking about risk, and this one usually shows up with institutions, liability-driven investing. Here, risk isn't about volatility or benchmarks. It's about failing to meet obligations. Pension payments, insurance claims, retirement spending. For these investors, risk means, will the money be there when it's needed? That mindset changes everything about how portfolios are built. Now let's talk about something that trips up a lot of candidates, risk tolerance. Risk tolerance is not one thing. It has two separate parts and both matter. Number one is the ability to take risk. This is objective. Time horizon, income stability, wealth relative to liabilities. So think about this in practical terms. A 30-year-old with a stable paycheck and no big financial obligations can take a hit in the market and recover. Time is on their side. A 60-year-old retiring next year, completely different story. There's no long runway left to make up for losses. This is why time horizon matters so much. The longer the horizon, the higher the ability to take risk. Same logic with surplus wealth. If you've got money left over after meeting all your goals, your ability to take risk goes up. Now, but flip it around, short time horizon, tight finances, and the ability to take risk drops sharply. So folks, remember for the exam, ability beats attitude. A client may feel fearless, but if the math says they can't afford losses, their risk tolerance is low, full stop. Number two is willingness to take risk. This is psychological. Comfort level, how someone reacts when markets drop. Some people lose sleep over small losses, others barely flinch during crashes. Questionnaires help here, but ultimately this is about human behavior, not math. Here's the rule you must remember for the exam. If ability and willingness conflict, you always go with the lower one. Always. If someone can afford risk but hates volatility, the portfolio stays conservative. Advisors can explain the trade-off, but they don't override a client's comfort level. Now, that principle shows up repeatedly in the exam to test candidates' understanding. All right, let's talk about key assessment profiles. When both ability and willingness to take risk are high, the client falls into an aggressive or above average risk profile. These are clients who not only can handle volatility financially, but are also mentally comfortable with ups and downs. For them, higher equity exposure makes sense because losses, while unpleasant, don't derail their long-term goals. On the other end of the spectrum, when both ability and willingness are low, The profile is clearly conservative, with a strong focus on capital preservation. These clients either can't afford losses, don't want to experience them, or both. Here, stability matters more than chasing returns, and the portfolio should reflect that reality. Now here's the exam favorite, folks: conflict. When ability and willingness don't match, the CFA exam answer is never aggressive. You always default to the lower factor, which almost always means a conservative profile. Now, this isn't about judging the client's courage. It's about protecting their financial future. And the advisor's job is to explain this trade-off clearly and document the decision in the IPS. If you remember just one thing for the exam, conflict equals conservative. Why? Well, this part is where CFA Institute really wants you to think like an advisor, not like a risk-taking hero. Risk tolerance has two pillars: ability and willingness. And when they don't line up, there's a strict rule. You always use the lower one. No debates, no compromises. So remember, folks, if a client wants to take a lot of risk but clearly can't afford losses, the answer is not meet them halfway. The answer is conservative. And if the client can afford risk but is emotionally uncomfortable with volatility, again, conservative. Ability and willingness must both support risk. Otherwise, you step down. You know, the advisor's responsibility doesn't stop there. When there's a mismatch, the advisor must educate the client, explain the consequences, explain the trade-offs, and then document the final decision in the IPS. This documentation piece is classic CFA exam language, so don't skip it. Okay, let's move to the return section now. Once risk is pinned down, return objectives come into play. And just like risk, returns can be stated in different ways. But first, remember, return objectives answer one simple question: how much return does this portfolio actually need to earn to meet the investor's goals? This isn't about chasing the highest possible return. It's about earning enough given the client's situation. There are two common ways to state return. The first is an absolute return, where you specify a clear target, like 10% per year. Very straightforward. The second is a relative return, where performance is measured against a benchmark. For example, 1.5% above the benchmark. That sounds elegant, but be careful with peer group benchmarks. CFA exam loves pointing out their weaknesses. They're often not investable, and they're hard to measure consistently because data and methodologies vary across providers. Okay, so let me repeat this part. Some clients state returns absolutely, like I need 8% per year. That number might be nominal or inflation adjusted, and you have to be careful reading the question. If inflation is mentioned, your brain should immediately ask, is this real or nominal? That distinction matters a lot on the exam. Other clients state returns relatively. Beat the benchmark by 1%. That's common for professional mandates. But peer group benchmarks, like wanting to be in the top quartile, are problematic. Not investable, not measurable, and mathematically impossible for everyone to be above average. If you see peer benchmarks in a question, expect criticism. Returns can also be stated before fees or after fees, before tax or after tax. For taxable investors, after-tax returns matter most. If taxes are mentioned, the exam almost always wants you thinking in after-tax terms. Now, I'll be honest with you. I've been teaching this for years, and this is one of those sections people think they understand until the exam proves otherwise. It's not the return number that trips candidates up, it's the fine print. Nominal or real, before fees or after fees, pre-tax or post-tax. The CFA exam won't slow down to remind you, it just assumes you caught it. Miss that detail, and the answer quietly slips away. So, this is one of those areas where smart candidates lose easy marks. Not because they don't know returns, but because they read too fast and miss the basis. One more thing, and this is critical. Return objectives must be realistic. A client wanting 15% annual returns in a low inflation, low rate environment should trigger warning bells. When expectations are unrealistic, the advisor's job is to educate, not to promise miracles. That judgment call shows up often in exam scenarios. So let's step back for a moment. Risk and return objectives are really about balance. High returns demand high risk. Constraints limit both. The IPS exists to lock that balance in place so emotions don't take over later. That's exactly why in our battle-ready summaries, we isolate these distinctions so cleanly, all in one place. When you see them separated like this, they're much easier to recall under exam pressure. And that's the whole purpose. Make the quiet details loud enough that you don't miss them on exam day. So, guys, remove hesitation, remove confusion, and protect easy marks. All right, so IPS constraints. And this is where portfolio planning starts feeling very real world. Up to now, objectives sound great on paper. Everyone wants high returns, low risk, smooth rides. But constraints are the reality check. They're basically the guardrails. They don't tell you what you want to do. They tell you what you're allowed to do. Let's start with liquidity because this one bites people the most. Liquidity is about cash, plain and simple. When is money actually needed? Not someday, but specifically when. Think of an individual who needs a down payment for a house next year, or a business owner who might need emergency cash if revenues dip. Or take insurance companies. Claims don't send calendar invites. They arrive when they arrive. Because of that, part of the portfolio has to sit in assets that can be turned into cash quickly without panic selling. That's why even long-term investors usually keep some portion in very liquid, short-term instruments. No liquidity planning means forced selling at the worst possible time. And that's how good portfolios blow up. Now shift to time horizon, which is closely connected but not the same thing. Time horizon answers the question, how long can this money stay invested without being touched? A 25-year-old saving for retirement has a very different horizon than someone funding university fees in 2 years. Longer horizons can tolerate more ups and downs because there's time to recover from losses. Short horizons? Not so forgiving. That's why risky or illiquid investments make sense for long-term goals, but are dangerous for short-term needs. Time horizon directly affects how much risk a portfolio can realistically take, not emotionally, but mathematically. Next comes tax concerns, and this one quietly eats returns if ignored. Taxes don't care how good your gross return looks. What matters is what's left after tax. For taxable investors, different types of returns are taxed differently. In many places, interest income is taxed more heavily than capital gains, and short-term gains are taxed more than long-term gains. So a taxable investor might prefer investments that grow in price rather than throw off frequent income. Compare that with a tax-exempt investor, let's say a pension fund, who honestly doesn't care whether returns come as income or gains. Same investment, completely different decision just because of tax status. Then we have legal and regulatory factors, which are non-negotiable. These aren't preferences, these are rules. Pension funds might be restricted in how much they can invest in equities. Some investors face limits on foreign investments. Guys, listen, company directors can't freely trade their own firm's stock whenever they feel like it. Insurance companies have strict asset class limits. Whether these rules make sense or not doesn't matter. Portfolios must obey them. Period. Finally, we get to unique circumstances, and this is where portfolios become truly personal. These are client-specific constraints that don't neatly fit anywhere else. Religious restrictions, ethical screens, ESG preferences, all of these live here. For example, under Islamic finance principles, certain industries and interest-based investments are off limits. Some institutions avoid weapons, tobacco, or companies with poor environmental practices. Even human capital matters here. A stockbroker whose income rises and falls with equity markets already has a lot of equity risk in their career, so it may make sense to dial down equity exposure in their portfolio. Same logic applies to startup founders, real estate developers, or anyone whose income is tied to a specific sector. Now here's an exam tip, and this one shows up a lot. Constraints don't cancel objectives, they shape them. On the exam, if you see a return objective that ignores liquidity needs, tax status, or legal limits, something is off. Always ask, can this objective actually be achieved given these constraints? So, what's the bottom line? Great portfolios aren't built by chasing returns. They're built by respecting constraints first and then optimizing within them. Get that mindset right, and half of portfolio questions stop feeling tricky. All right, let's keep the vibe going and move to the next section, gathering client information. Now, this section is where portfolio management stops being theory and starts feeling like a real conversation across a desk. So imagine this for a second. A client walks in and says, I want good returns, but I don't want to lose money. Yeah, welcome to finance. That sentence alone tells us absolutely nothing. And that's exactly why gathering client information matters so much. This whole section is about one simple idea. Good portfolios start with good questions. So, guys, gathering client information basically is before you touch the money, shut up and listen section. And I'm saying that as someone who's been teaching this for years. If you rush this step, everything downstream, IPS, asset allocation, risk profile, it all goes wrong. Let's start with the purpose, because that's the anchor. Effective portfolio management starts with actually understanding the client, not the account size, not the returns they say they want. The person, their life, their pressures, their fears, their timeline. A portfolio is not a spreadsheet, it's tied to real human behavior. And timing-wise, this information is gathered right at the beginning of the relationship, not after losses, not after complaints, right up front. Regulators care about this, courts care about this, and examiners absolutely care about this. Now, how do advisors actually gather this information? Sometimes it's informal, conversations, meetings, back and forth emails. Other times it's formal, questionnaires, structured interviews, data analysis. In the US, for example, most registered investment advisors use onboarding forms combined with risk questionnaires and documented meeting notes. And increasingly, all of this gets captured electronically. Why? Because if something ever goes wrong, good records protect both the client and the advisor. Now let's talk about what information is collected, because this is exam gold. First, you're gathering the client's personal and financial circumstances, income, assets, liabilities, job stability, the basics. But it doesn't stop there. You also need to understand investment objectives and requirements. Retirement, education funding, legacy planning, short-term cash needs, family matters too, a lot. If a client has dependents, aging parents, or a spouse with different financial needs, that changes everything. Health status is also relevant. And yes, this shows up in real advisory practice. Someone with serious health issues may have a very different time horizon and liquidity need than someone in perfect health. For institutional clients, the lens shifts. You're no longer dealing with one personality, you're dealing with stakeholders, trustees, sponsors, beneficiaries, boards, and very often their interests don't perfectly align. That's why institutional fact-finding can be messy but critical. Now, here's a real-world point students often miss. This isn't a one-time exercise. The initial fact-finding happens at the start, but it should be revisited whenever circumstances change. Job loss, inheritance, marriage, divorce, regulation changes. Portfolios don't exist in a vacuum. Okay, next, let's talk about types of client relationships, because this matters a lot under regulation and on the exam. Now see, in an advisory relationship, the firm gives advice, but the client makes the final investment decisions. Think of a U.S. brokerage advisory account. The advisor says, here's what I recommend, and the client says yes or no. Responsibility is shared, but the advice still has to be suitable. In an execution-only relationship, it's very different. The firm is basically an order taker. The client decides what to buy and sell, and the firm just executes the trades. No advice, no portfolio construction. But, and this is important, even here, regulators still require basic fact-finding. You don't get a free pass just because the client clicks the buttons themselves. In Europe, this is formalized under MiFID II. Even lighter relationships still require suitability and appropriateness checks. The exam loves this idea. Less advice does not mean zero responsibility. Now let me give you a simple example so that it sticks. Imagine two clients walk into a U.S. advisory firm. One is a 30-year-old software engineer in Austin with a high income, no dependents, and stock-based compensation. The other is a 55-year-old small business owner in Ohio planning to sell their business in 5 years. Same account size, totally different portfolios. Why? Because the information you gather drives everything. And here's the quiet exam takeaway I want you to remember. You cannot define risk, return, or constraints correctly unless you've gathered the right client information first. The IPS doesn't come first, the client does. And as you're watching the battle-ready summary on screen, notice how cleanly we separate purpose, information collected, and relationship type. That's intentional. Under exam pressure, clarity beats memory. If you can mentally walk through these categories, you won't miss questions. All right, this section isn't flashy, but it's foundational. Get this wrong, and no amount of asset allocation magic will save the portfolio. Get it right, and everything else becomes easier, cleaner, and defensible in practice and on exam day. All right, now we're finally at the part students think portfolio management is about, meaning portfolio construction. And yeah, this is where things start to feel real. But here's the first mindset shift. Portfolio construction is not guesswork, and it's definitely not stock picking. It starts from one place and one place only, the IPS. Everything flows from that document. No IPS, no portfolio. Simple as that. So think of the IPS as the blueprint. It tells us what we're allowed to do, what we're not allowed to do, how much risk is acceptable, what the return needs to look like, and what constraints we're working under. Portfolio construction is just the execution of that blueprint. In real life, if an advisor ignores the IPS and builds a portfolio based on market vibes, that's how lawsuits happen. On the exam, that's how wrong answers happen. Now, once that foundation is clear, the next step is integration. And this is important. Portfolio construction isn't just about picking investments you like. It's about combining the client's objectives with capital market expectations. In other words, we're asking, given how we expect markets to behave over the long run, how do we build a portfolio that actually makes sense for this client? Now, let's talk about what capital market expectations really mean, because the phrase sounds intimidating, but the idea is simple. So, in simple words, capital market expectations are long-term forecasts of how different asset classes are likely to behave in terms of risk and return. Not next month, not next quarter. We're talking years, even decades. There are three core pieces here, and the CFA exam loves all three. First, expected returns. This is our best estimate of what an asset class might earn over time. Second, risk, usually measured by the standard deviation of returns, basically how bumpy the ride is. And third, correlations, which tell us how different asset classes move relative to each other. Now, this third one is where portfolio magic happens. For example, here in US, stocks and long-term treasury bonds have often moved differently during economic stress. When equities fall sharply, high-quality bonds may hold up or even rise. Now, I know individually bonds might look boring, but in a portfolio, they can be incredibly powerful, folks. Now, how do we actually estimate expected returns? CFA Institute highlights three broad approaches. The first is historical return analysis. This is the most intuitive. You look at long-term data and say, historically, US large-cap stocks have earned around X%, investment-grade bonds around Y%. But here's the catch. History is informative, not predictive. The exam loves reminding you that past returns are a starting point, not a guarantee. Now, the second approach is economic analysis. This is where you bring in growth expectations, inflation, productivity, and demographic trends. For example, if the US economy is expected to grow more slowly due to an aging population, long-term equity return expectations may be adjusted downward. This is forward-looking and more judgment-based. Now, the third approach uses valuation models, and this is very CFA Institute's style. Expected returns are often expressed as the risk-free rate plus a risk premium. So think about US Treasury bills as your baseline. That's the risk-free rate. Then you add a premium for taking equity risk, credit risk, or liquidity risk. This framework shows up everywhere in the curriculum, so get comfortable with it. When you step back, the big picture is this. Portfolio construction is not about chasing returns or guessing markets. It's a disciplined process. Start with the IPS. Then combine it with long-term capital market expectations, understand risk, return, and correlations. And then build a portfolio that makes sense as a whole, not as a collection of isolated investments. And that mindset, thinking in portfolios, not in individual securities, is exactly what CFA Level 1 is trying to train you to do. Now, see when you put it all together, the flow is very clean. The IPS defines the rules. Capital market expectations define the opportunity set. And strategic asset allocation sits at the intersection of the two. That allocation, more than security selection, more than market timing, drives the portfolio's long-term outcome. And this is where students often get an aha moment. Portfolio construction is about structure, not prediction. You're not trying to guess the next winner. You're trying to build a portfolio that makes sense across many possible futures. All right, so this is the moment where everything finally comes together. Up to now, there's been a lot of groundwork, IPS, objectives, constraints, risk tolerance, all that. Now, strategic asset allocation is where all of that stops being theory and actually turns into real money decisions. Think of SAA as the long-term blueprint of the portfolio, not the day-to-day trading stuff, not tactical moves. This is the big, boring, powerful decision. How much goes into equities, how much into bonds, how much into cash, real estate, alternatives, and why. In practice, and as we have discussed in previous section, SAA is created by combining the IPS with capital market expectations. That's it. Those two inputs. Nothing fancy. And once those target weights are decided, say 60% equities, 30% bonds, 10% cash, that becomes what we also call the policy portfolio. And here's an exam critical idea. Most of a portfolio's long-term performance is driven not by security selection, not by market timing, but by this asset allocation decision. And CFA exam loves this idea. Okay, now, strategic asset allocation reflects the investor's target exposure to systematic risk. And there are two principles driving this. First, over the long run, portfolio performance is driven primarily by systematic risk, not by individual stock picks. Second, assets that look similar, say large cap US equities, tend to have similar exposure to the same systematic risk factors. That's why we think in asset classes, not individual securities at this stage. Now, you might be wondering why SAA matters and why CFA Institute keeps testing it. Well, here's the intuition. Over long periods, portfolio ups and downs are dominated by systematic risk. Things like economic cycles, inflation, interest rates, growth shocks. These risks hit entire asset classes together. Picking Apple versus Microsoft doesn't change that much over 20 years. Choosing equities versus bonds absolutely does. That's principle number one. Long-term portfolio value is mostly driven by exposure to systematic risk. Principle number two follows naturally. Assets that look similar tend to react similarly. Large cap US stocks move together. Government bonds move together. High yield bonds move together. That's why we group assets into asset classes in the first place. Okay, now here's something candidates often underestimate. Strategic asset allocation is not set once and forgotten. It must be updated when either capital market expectations change or when the client's objectives or constraints change. Think about it this way. If inflation expectations suddenly jump, interest rate outlook shifts, or expected equity returns decline, the long-term return assumptions driving your asset mix are no longer valid, and that means your target weights may need adjustment. On the client side, imagine a young professional who suddenly receives a large inheritance, or someone 5 years away from retirement instead of 15. Their risk tolerance, liquidity needs, or time horizon may shift. And when those foundational inputs change, the policy portfolio must evolve too. So SAA is strategic and long-term, but it is never static. So now comes the next question. What exactly is an asset class? An asset class is simply a group of investments with similar risk-return behavior. Nothing mystical here. Think about cash first. Cash behaves like cash, very low risk, very low return. Then you've got equities. Stocks move differently than cash, so they clearly belong in a different bucket. And even within equities, not all stocks act the same. US stocks don't behave exactly like international stocks. Developed markets don't move the same way as emerging markets. Large cap stocks feel very different from small cap stocks when markets get shaky. Now move over to fixed income. That's its own universe. Government bonds, investment grade corporates, high yield bonds, domestic bonds, foreign bonds, different risks, different sensitivities, especially to interest rates and credit conditions. Then there's real estate. It doesn't move like stocks or bonds all the time, which is why it gets its own category. And finally, alternatives. Things like private equity, hedge funds, commodities, natural resources. These don't fit neatly into the stock bond box, so they live in their own lane. Now, here's the very practical reason this shows up in the exam. Asset classes aren't just theory. They reflect how the real investment world is organized. Investment managers specialize. You don't hire the same manager to run treasury bonds and a private equity fund. Completely different skills, different risk profiles, different time horizons. Now, before we can even build a portfolio, we have to agree on a very basic question. What exactly is an asset class? CFA Institute doesn't let us define asset classes casually. There are clear criteria. Now, your CFA Institute has 4 criteria in mind, and these are very exam friendly. First, there has to be homogeneity within the asset class. That just means the assets inside a class should behave in a broadly similar way. They should have similar expected risk and return, and they should be highly correlated with each other. For example, U.S. large cap equities tend to move together because they're driven by the same economic forces, growth, interest rates, inflation. That's what makes them a coherent group. Second one is asset classes should show mutual exclusivity. In plain English, an asset should belong clearly to one class, not half in one and half in another. This avoids double counting risk. If an asset fits everywhere, it doesn't help you understand the portfolio. Then the third, and this is where diversification actually shows up, asset classes should offer diversification across classes. That means lower correlations between different asset classes. Stocks, bonds, and real assets don't all react the same way to economic shocks. And that difference is exactly why combining them reduces overall portfolio risk. Finally, a good set of asset classes should provide broad coverage of global investable wealth. You don't want a framework that ignores large parts of the investable universe. Equities, fixed income, real estate, and alternatives together capture most of the world's investable opportunities. Put all of this together and you get the CFA mindset. Asset classes are not labels, they're risk groupings. If the assets move together, they belong together. If they move differently, that's where diversification comes from. And that's the logic you'll see tested again and again in level 1, usually in subtle ways. All right, now let's lock into this slide properly. This entire slide is really one story, just told in stages. So first things first, what actually determines the risk and return of a strategic asset allocation? 3 things, always 3. If you remember nothing else, remember this trio. Number 1 is the expected returns of asset classes. Stocks are expected to earn more than bonds, bonds more than cash. That's the basic trade-off. Number 2 is risk, usually measured as standard deviation. Some asset classes simply swing more. Equities move more than government bonds. High-yield bonds move more than investment-grade bonds. And number 3 is correlations among asset classes. Now, this is where diversification lives. Lower correlation means better diversification benefits. When assets don't move together, portfolio risk comes down. But here's an important exam nuance. Diversification is powerful, but it's not magic. The standalone risk of an asset class should not overwhelm its diversification benefit. No, remember, folks, adding a wildly volatile asset just because it has low correlation doesn't automatically help. Now, once those 3 ingredients are clear, the allocation starts to look predictable. A risk-averse investor, think retirees, pension plans, paying benefits, conservative institutions, will naturally tilt toward cash and government bonds. Stability first, growth second. A risk-seeking investor, long horizon, stable income, strong balance sheet, will tilt more toward equities and alternative investments. That's not reckless. That's aligned with capacity and willingness to take risk. So guys, this is exactly how portfolios are built in practice. All right, so let's talk about something that sounds mathematical, but is actually very human, the utility function. At the end of the day, most investors are not thrill seekers. They don't wake up thinking, how much volatility can I tolerate today? What they really want is this: either give me more return for the same risk, or give me less risk for the same return. That preference, that emotional comfort level, is what we're trying to capture with the utility function. Now, the formula looks scary on paper, but the idea is simple. Expected return makes investors happy. Risk makes them uncomfortable. So utility is basically happiness minus discomfort. That's all. When you see U equals expected return minus lambda times risk squared, what it's really saying is, sure, returns are good, but returns that come with wild swings, not so much. The lambda term is key here. Lambda tells you how sensitive the investor is to risk. High lambda means I really hate volatility. Low lambda means I can live with ups and downs. Same portfolio, same numbers, totally different reactions depending on who's looking at it. And this explains something very important. Two investors can look at the same portfolio and disagree, and both be right. Now let's connect this to the properties of the utility function. As expected return goes up, utility goes up. That makes sense. Nobody complains about higher returns. As volatility goes up, utility goes down. Again, intuitive, large swings reduce comfort. And the stronger that penalty on volatility, the more risk averse the investor is. That's your lambda doing its job. So far, so good. But, and this matters for your CFA exam, the utility function is not perfect. It doesn't fully capture all the real-world constraints written in the investment policy statement. Taxes, liquidity needs, legal restrictions, multi-year goals, none of that fits neatly into one simple equation. Also, the utility function lives in a single period world, while real portfolios live across decades. That's why when things get more complex, simulation techniques are often preferred. So think of the utility function as a clean decision tool, not a complete description of reality. Okay, now let's move to the efficient frontier. What really brings the efficient frontier to life is this idea that you can have multiple portfolios showing the same expected return, yet feeling completely different because the risk underneath is not the same at all. That's literally why the efficient frontier exists. When you start mixing in assets that don't move together, low correlation assets, the overall portfolio becomes more stable, risk comes down, and suddenly the efficient frontier lifts upward. You get better choices. Flip that around though, and if you load the portfolio with assets that all move in the same direction, risk jumps and the frontier slides downward. Same return target, very different experience. Now here's where people often get confused. If expected returns change because, say, the economic outlook improves, but volatility and correlations stay the same, the entire efficient frontier shifts. But if what changes is the investor, retirement gets closer, income needs go up, constraints tighten, then the frontier doesn't move at all. What moves instead is the investor's indifference curve. That difference between markets changing and investors changing is subtle, but it's exactly the kind of detail the CFA exam likes to quietly test. So now we're finally at the point where everything comes together. This is the optimal portfolio, or what the CFA Institute also calls the strategic asset allocation, the SAA. And this is not some random mix of assets. This is the sweet spot. Think of it like adjusting the seat and mirrors in your car. Lots of settings might technically work, but only one feels right for you. Here's the intuition. You've got the efficient frontier sitting there showing you all the best portfolios the market can offer, the maximum return for each level of risk. Separately, you've got the investor's indifference curves, which quietly tell you how much risk that investor is actually willing to tolerate for extra return. When those two just touch, that point of tangency is the optimal portfolio. That's the portfolio that gives the highest expected utility for that investor's level of risk aversion. Not the highest return, not the lowest risk, the highest utility. Picture a U.S. endowment fund, say a university with steady donations but long-term spending needs. It could choose a very aggressive, equity-heavy portfolio and chase returns, or it could sit mostly in bonds and sleep well at night. But neither extreme is optimal. The optimal portfolio is where the fund says, yep, this level of volatility is uncomfortable but acceptable given the return we're getting. That exact mix, equities, bonds, maybe some real estate, that's the tangency point. And that point, that is the SAA. And here's the key exam takeaway, so listen carefully. The SAA is not chosen by guessing, and it's not chosen emotionally. It's chosen where the efficient frontier meets the investor's indifference curve. If markets change, the frontier shifts and the SAA changes. If the investor changes, risk tolerance, constraints, time horizon, the indifference curve shifts and the SAA changes. Either way, that tangency point is always your anchor. Once you see it this way, this concept stops being abstract. It's just markets on one side, the investor on the other, and the SAA is where they finally agree. All right, let's bring everything together in portfolio construction principles, because this is where the IPS finally turns into an actual working portfolio. We start with an important clarification. Strategic asset allocation by itself is not the portfolio. It's the blueprint. It tells us the long-term policy weights, how much equity risk, how much bond risk, and so on. But nothing has been invested yet. Think of SAA like an architectural plan. Until you actually build the house, it's just paper. So the first job of the portfolio manager is to implement the SAA into a real portfolio. That's where portfolio construction truly begins. Now, for quantitatively oriented managers, which is most of the institutional world, the next big step after SAA is risk budgeting. And risk budgeting sounds complicated, but the idea is simple. Risk budgeting means two decisions. First, how much total risk is the portfolio allowed to take? That decision already came from the IPS. So at this stage, we're not arguing about total risk anymore. The second decision is more practical. How do we divide that risk across different return sources? In other words, how much risk comes from the strategic asset allocation itself? How much from tactical moves? And how much from security selection? This division matters because every extra return source comes with extra uncertainty. Now, let's talk about those sources of portfolio return, because CFA is very structured here. The first source is SAA itself. Long-term returns come from exposure to systematic risk, equity risk, interest rate risk, credit risk, inflation risk. This is the part you actually get paid for over the long run. If you do nothing else but stick to your policy portfolio, this is where returns come from. The second source is tactical asset allocation, or TAA. TAA means deliberately deviating from policy weights because you have a short-term view. For example, suppose a U.S. pension fund believes equities will outperform bonds over the next 6 months. The policy might say 60% equities, but tactically they move to 65%. That extra 5% is a tactical bet. The return from TAA is very precisely defined in CFA language, folks. It's the difference between the actual return and the return you would have earned at policy weights. And the key exam point is that a TAA adds risk on top of SAA. It is not free. Now, let's move to the third source, which is security selection. This is the classic attempt to beat the benchmark by choosing better securities. For example, an equity manager may overweight IBM relative to the benchmark because she believes it will outperform, and underweight another stock expected to underperform. That decision introduces active risk. Now here's where the CFA exam becomes brutally honest. Security selection is a zero-sum game. Before costs, the average active manager must earn the market return. For every manager who beats the benchmark, another manager must lag it. And once you subtract trading costs, research costs, and management fees, the average active manager underperforms. That doesn't mean skill doesn't exist. CFA Institute is very careful here. Some managers do have skill and can outperform consistently, and not all passive managers perfectly track benchmarks either, especially when turnover is high and trading costs increase. But as a group, active management is a tough game. This brings us naturally to the active versus passive decision, which is really a risk budgeting decision. If you allocate risk to security selection, you are making an active choice. If you don't, you're effectively passive. Whether active management makes sense depends on two things: manager skill and market efficiency. In highly efficient markets, like U.S. large cap equities, prices reflect information very quickly. Beating the market consistently requires exceptional skill. In less efficient markets, say certain regional bond markets or smaller equity markets, skilled managers may have more room to add value. Now, you may have observed sometimes the active decision is made for you. In markets like non-listed real estate or infrastructure, passive exposure isn't really possible. You're forced into security selection simply because the assets are illiquid. Now let's move to risk and rebalancing, which is hugely important for real portfolios. Over time, asset class weights drift. If equities outperform bonds, equities become a larger part of the portfolio, even if you did nothing. This is called drift, and drift changes the portfolio's risk profile. That's why portfolios need a rebalancing policy. Rebalancing restores the original exposures to systematic risk. Sometimes it happens on a schedule. Sometimes it happens when weights breach a corridor or bandwidth. Either way, rebalancing is a form of risk control, not market timing. The European charity example in the curriculum shows this beautifully. So, if you look at this example in your curriculum, you can actually see this happening step by step. Equity markets go up, equity weights slowly drift beyond the allowed range, and the committee decides not to rebalance right away. That decision is a tactical call, whether they label it that way or not. When equities later fall, the portfolio takes a hit because of that earlier choice. So, simple. Not rebalancing isn't a neutral move. It's an active decision, and the exam treats it exactly that way. Finally, we come to new developments in portfolio construction, One major development is the rise of ETFs and robo-advisors. ETFs provide low-cost, liquid, efficient exposure to asset classes. Robo-advice uses algorithms to build diversified portfolios cheaply, making institutional-style diversification accessible to retail investors. The second development is criticism of traditional MPT inputs. Small errors in expected returns or correlations can lead to very different portfolios. In response, practitioners developed risk parity approaches, where assets are weighted by risk contribution rather than capital weight. Now, risk parity supporters argue that traditional portfolios underestimate equity risk because equities are much more volatile than bonds. Critics argue that risk parity benefited unusually from falling interest rates after the global financial crisis. Now your CFA Institute presents both sides. Not to pick a winner, but to show you the evolution of practice. Okay, so what we have learned here is that portfolio construction is not about finding the best stock. It's about deciding where risk comes from, how much of it you want, and how disciplined you are in managing it over time. That mindset, disciplined, structured, risk-aware, is exactly what Level 1 is training you to adopt. Okay, so now we're inside the asset management industry, and ESG is no longer a buzzword. It's part of portfolio planning, whether people like it or not. Environmental, social, and governance factors don't just sit on the sidelines. They actively affect strategic asset allocation and portfolio construction. In plain English, ESG can change what you're allowed to invest in, how you invest, and how much risk and return you end up with. Now, here's the first big idea. ESG isn't something managers kind of consider. If a portfolio has an ESG mandate, and many do, that mandate must be explicit. It has to be written clearly. Are we excluding certain sectors? Are we favoring companies with strong governance? Are we actively engaging with management? That instruction shapes strategy, security selection, and even shareholder engagement. No ambiguity here. And this matters because ESG constraints can change the risk-return profile of a portfolio. If you exclude entire sectors, say fossil fuels or tobacco, you've just shrunk your investable universe. That means diversification changes, risk changes, and expected returns may change too. Because of that, asset managers often use ESG adjusted benchmarks. Comparing an ESG restricted portfolio to a broad market index wouldn't be fair. It's apples and oranges. Now let's talk about how ESG actually gets implemented, because this is where exam writers love to test definitions. First up, negative screening. This is the simplest approach. Certain sectors or companies are just off limits. No weapons, no tobacco, no coal. End of story. Next is positive screening, also called best in class. Here, you're not excluding entire industries. Instead, you're selecting the ESG leaders within each industry. So yes, energy companies might still be included, but only the ones with better environmental practices and governance. Then there's thematic investing. This is more focused. The portfolio targets specific ESG themes: climate change, renewable energy, water scarcity, gender diversity. The investments are chosen because they directly tie into that theme. And finally, impact investing. This goes one step further. The goal isn't just financial return, it's measurable social or environmental impact along with returns. Think affordable housing, clean energy in developing regions, or access to education. Measurement matters here. Now let's shift to shareholder engagement, because ESG isn't always about buying or selling. Sometimes it's about influencing. Large asset managers actively engage with company management, voting proxies, holding meetings, pushing for better governance or disclosure. The goal? Protect firm value or even enhance it over time. This isn't activism for headlines. It's long-term value protection. Okay, here's a real-world way to think about it. Let's say a large U.S. pension fund holds shares in a global manufacturing firm. Now, instead of selling because of weak labor practices, the fund engages, votes against certain board members, pushes for policy changes, and monitors progress. That's ESG engagement in action. So remember, folks, ESG affects strategic asset allocation, portfolio construction, risk and return, and benchmark selection. ESG approaches include negative screening, positive screening, thematic investing, and impact investing. And shareholder engagement is about dialogue and voting, not trading. If you can explain this section like a story, restrictions, choices, engagement, and consequences, you're in great shape. This is the kind of topic where understanding beats memorization every single time. All right, that's the asset management industry with ESG. Clean, practical, and very real. And this is exactly why our battle-ready summaries are structured the way they are. Clean, exam-focused, last-minute review style. So right before your CFA exam, you can instantly recall when this module must be revised. Go check the PDFs for all learning modules, and you'll see how we isolate these trigger points for quick, confident exam recall. Okay, folks, that's it for today. See you in the next lecture. Until then, happy studying.